Hi, I'm Jimmy. In this video, we're looking at stagflation. So recently, you might have seen a whole bunch of articles pointing out that stagflation may be hitting the US economy. So the goal of this video is to look at what is stagflation and ultimately what investments perform the best during a stagflationary environment. Okay, so I think the simplest way to define stagflation is to really just break up the word to see how they came up with it. Basically, stag is representing that it's a stagnant economy. The economy is either not moving or you go into a recession. So either, let's say, flat to down, and then inflation, you have higher inflation than normal, or higher inflation than, let's say, what the Federal Reserve is targeting. And although this isn't really representative in the name itself, one underlying expectation is that stagflation will come along with higher unemployment. Okay, so now let's go and look at where we've actually experienced stagflation in US economic history. Basically, the clearest possible time frame for when there's no doubt the US was in stagflation was in the late 70s, early 80s. Call it 72, 73 on to 82, 83. So during about that decade, we were in a stagflationary environment. This is the S&P 500 during that time period. And as we could see, it barely moved. Now, this is the price of the S&P 500. If you actually accounted for inflation, we'll look at that in a second during this time period. If you accounted for inflation, the S&P 500 had a massive pullback on an inflationary adjusted period. But even if you don't look at inflationary adjusted, didn't do much of anything over the decade, just kind of ebbed and flowed through that time period. So this is what stagflation did to the stock market. And one of the causes of that stagflation was inflation. So this is inflation during that time period. And we can see that although, again, it kind of ramped up and then pulled back and then ramped back up, at times, inflation got real out of control. You're talking double-digit inflation, 14 or so percent. This is an extraordinarily high inflation. We recently came off of somewhat high inflation after COVID, but that topped out at like 9%. This is 14%, and it stuck around for a little. So clearly, this is far above the target rate that the Federal Reserve and the US government is trying to target from an inflationary rate. Generally, they want somewhere between, let's say, 2.5% and 3%. So clearly, during this time period, during the stagflationary environment, things got pretty bad. Now, how did this affect the growth of the economy? Well, we have the benefit of hindsight now, where we can look back at this time period where we know stagflation was happening, and we can see that not only was there high inflation, which we just saw, but GDP didn't grow all that much. In fact, during this time period, I think the important point here is just note the red line. That is zero. Anything below zero here is a recession. Now, technically, a recession is 2 consecutive quarters of negative growth. That's the way the Federal Reserve defines it. And fine. But each of these 3 time periods that were below it were all recessions. And it continued a little bit beyond this time period. So clearly, this is a problem this is, let's say, setting up the framework for a stagflationary environment. Now, for the final piece of the puzzle, let's jump over and look at unemployment. So this is an unemployment rate going back quite a period of time. But we can see back here in the 70s and 80s, well, unemployment got pretty high. Now, of course, the reason I want to show the whole chart is COVID is obviously in there. And we can call that a bit of an anomaly if we'd like. But that gigantic spike, I just want to acknowledge that did happen. And there was actually fear coming out of COVID that inflation they knew was going to happen because they were printing up tons of money. Unemployment spiked incredibly high. So there was concerns as to whether or not stagflation was going to hit the market after COVID happened, but it's debated as to whether or not it actually did, because unemployment came down pretty quickly after. Now, one good measure of stagflation that you can look at is over on the Investors Grow website, we have something called the misery index. You can find this in different places. And basically, what it does is it takes unemployment and it adds inflation. Really that simple. Unemployment plus inflation. And we can see back during the 70s and early 80s, well, it was the highest level we've had the whole time in this entire time period, which is a long time. But this was clearly a problem for the economy. Now, the question is, during this time period, you have a higher than what we would like from an unemployment perspective. relatively high inflation compared to their 2.5 to 3% target rate, and relatively slow growth. So when you combine all of those, well, what stocks or what, let's say, sectors or industries tend to perform better? Well, the first and probably the most obvious, and we're already starting to see signs of this right now, is investors and portfolio managers adjust their portfolios to account for the potential of stagflation coming. Well, commodities do well. Any hard assets, so think like metals like gold or silver, oil and gas tends to do fairly well because prices tend to run up as inflation happens. Commodities, wheat, agriculture products, things like that, commodities tend to have their prices go up. So if you're an oil and gas company and you pull oil out of the ground, or perhaps you're a gold miner and you pull gold out of the ground, if those prices go up, well, you're now selling your products for more. So in theory, that's a good thing. So back in the 70s and 80s, gold, oil and gas companies, these guys crushed it. Compared to the performance of the stock market, they did significantly better than the stock market. Now, in 1971, I believe it was, the US came off of the gold standard. Gold at that time was like the gold standard was at $35 an ounce. Well, by the early 80s, it was trading up over $800 an ounce. So the performance there was simply magnificent from a return perspective. So all indications are those types of investments would continue to do fairly well if the US were to end up in that situation today. Well, another potential investment that could do fairly well, we kind of looked at this after COVID. I did a video about them, but these are Treasury inflation protected securities, also known as TIPS. Basically, they're bonds the US government issues. They're bonds that adjust the yield that they're paying based on the inflation rate. The inflation rate is kind of baked into it. So if hypothetically we were to buy it now and inflation were to go to, imagine it went to the levels of the early 80s where it's up at, 10, 12, 14%, well, that's the returns you're getting on the bonds. Now, I will leave a link in the description below for the video that I did on Treasury inflation protected securities, because it's a bit more nuanced than that. It's not as simple as just buying the bond and holding. It can get a little bit more complicated than that. But that historically is an investment that did fairly well. Okay, now another investment that historically has done fairly well, and this one, although it has done well, I am questioning it given the current situation of the real estate market in the United States. So real estate typically would do fairly well. Inflation would generally drive the price of houses and land higher. Well, that kind of makes sense if you think about it. It'll drive the, hard assets higher. Inflation, landlords and whatnot would increase their rent based on what inflation is doing. So inflation typically drives those up. Although the argument could be made today that the US market, housing market in particular, is already a bit too high. So this is something I think we should keep in the back of our mind, but it's not necessarily something that we should just jump into without doing a decent amount of research. If we're going to buy something targeting real estate, I think it makes a lot of sense to make sure we do deep dives on whatever REITs or real estate investment trusts is what that is short for, or like farmland REITs, things like that. Things like that could be good investments, but we want to make sure we're not overpaying at this point. Now, another investment that could do fairly well and is it's a bit simpler, is consumer staples. Think of things like utilities or healthcare or food, not food more like a company like a Kellogg's or something like that. Well, back in the 70s and 80s, those companies did fairly well, partially because as inflation goes higher, if inflation were to ramp up, you can't really stop these guys from increasing their prices too much. And you kind of need to keep buying their products. You can't stop buying food altogether. You could adjust the foods you're buying, but broadly speaking, you have to keep buying food no matter what the price is. So that is an industry that can generally maintain their margins fairly well in a stagflationary environment, or even in an environment with higher inflation. A lot of times, food and utilities and healthcare, those are some of those that, again, if they up their prices, you really don't have a choice. Now, as far as the healthcare one, proceed at your own risk, because clearly I would imagine there's going to be a lot of government intervention almost no matter what administration is in charge. The US healthcare system can be a bit complicated, so sometimes it might be simpler to just stick with the other two, but I did want to mention it because historically they have done fairly well. Okay, now the final point to consider with stagflation that I think is very, very important to consider is that if the United States does go into stagflation, the real question would be, well, how do you get out of it? And because we were in it in the 70s and 80s, well, we can kind of look back at what did they do to get out of it. Now, the number one thing to keep in mind here is that the way you get out of it is, frankly, you sort of invoke some short-term pain to clear the way for long-term growth. This is a patience game. This is the scenario that if we are investing in a stagflationary environment, generally value stocks are going to be better than growth stocks. And I own a decent amount of growth stocks in my portfolio, but I am actively looking for value stocks because value stocks tend to do better because growth stocks will have pressure put on them because of the environment. Now, if you go back to the 70s and 80s, this is the Fed funds rate. The Fed funds rate, as we can see just recently, was down near zero. Then they upped it to 5%, and then they started to pull back. And now there's questions. There's all sorts of news coming out about the Trump administration as to what they're doing with the trade wars and what they're doing with the tariffs. And there's also news about what Jerome Powell's going to do. Is he going to decrease interest rates? Is he going to leave them stagnant? There's been no sign that he's going to increase them just yet. But the problem is this stuff takes time. It takes a lot of time to play itself out. Well, the way that they came out of stagflation back in the 80s is they jacked up interest rates. I mean, this is the Fed funds rate. This is the overnight rate that the Fed funds rate went up to double-digit levels. So mortgages would get significantly more expensive. When they drove it up, this is, I believe, Volcker was in charge of the Fed when that happened, if I'm not mistaken. He drives up interest rates. He drives them way up, forcing the economy into a recession. But that ultimately pulls back inflation, and unemployment. Then when they start decreasing interest rates, unemployment gets on track. And before you know it, you ended up with the economy that we've been used to over the past 30 or so years that has recovered fairly quickly. The thing I would point out is that if you look at this time period, it took a little while. If we were to be put in a situation we end up in a stagflationary environment, it's not a quick flip around. It's not a quick switch. You can't just quickly turn it off. Generally, there will be a little bit of pain. You'll have to cause a little bit of short-term pain to get the economy rolling correctly again. So overall, I would look for value stocks and try to pay attention to the investments that tend to do fairly well. Besides that, dollar cost averaging makes a ton of sense. Now, if you have any good investment ideas that I should do deep dives on that you might be considering for your own portfolio, please let me know in the comments below. And if you want to sign up to get access to the Investors Grow website, I will leave a link right here. I'll link it in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.